to the Twomey Stock Market Report. I'm James Twomey, and today is Monday, October 31st, 2022. Well, we've got a lot to get into in this weekly report. I want to go over a couple of things. The market definitely seems to be improving, and we need to develop our fundamentals and technical analytics, meld them together, and make sure bias doesn't take over. But for now, we definitely are seeing some good sign and good news. So I want to go over the advanced decline. That will give us a good snapshot. It's not just rear view mirror, but it helps us in understanding where the market may go. Then I want to do a quick analysis of how the diamonds versus the SPY, or the Dow Jones versus the S&P, and what is interesting on that development that I found. We'll go over some of our trades, and then if we have some time, we'll go over energy, bonds, and then a little bit about bear market history and how markets may react to the midterms that are coming up. So first, let's take a look at the advanced decline. One of the things that we saw, and this is based on the close of last Friday, is, as you can tell in this advanced decline, in the meat of the chart here, this is really, it tracks on a daily basis, advances over declines. And then obviously, if it's going down, that means more declines than advances. And if it starts moving in an upward slope, more advances than declines. So what are we seeing here? We did bounce off in mid-October at some of the bottom areas here. And we had one false breakout, bounced again, but it never quite got to the lows again, and it has surpassed that, and it's on its way up towards the 50 EMI, exponential moving average. That's very positive. We haven't touched upon that, and the last time we did and broke through, it was very brief, and then we continued to go down. If we look some of the other things to understand about it. So what does that say? In the last couple of weeks, or last several days, we definitely have more advances over declines, which is a positive indicator that we're getting some good improvement on the base price of the indices out there. In addition to that, we're kind of going through a couple of newsworthy areas with earnings release. And what did we find on earnings release? We had some great news on some of the Dow Jones stocks, or some of the more larger industrials out there earlier, and even the transportation like Delta Airlines and United, etc. But then we ran it, and they gave a real nice bounce to the market. But then we ran into the major high tech ones. We had Meta, we had Amazon, Intel, Microsoft, Google, or Alphabet, and they all gave us some really tough news as far as past earnings, ad revenue, cloud revenue, and then the forecast. Intel was in there as well. And the only two that really weathered that storm okay were Apple, potentially Intel, if you will, and then also the Microsoft rebounded. But everything else, I mean, for the most part, they all took some overnight drops, anywhere from 15 to 25%. So when they opened up the next day, some of them rebound, obviously, as the market rebounded last week. But what is that telling us? The high-tech sector, no surprise, under pressure, right? Because people are not investing in the future growth type stocks. They don't know what the future is going to bring, but they are looking at some of the industrials and saying, hey, they're tried and true. Also, too, if you're looking under the hood on that, really the high techs are ones that are cutting back and not hiring and laying off some folks. Yeah, there's a couple like Credit Suisse and a few others, like Amogen, that are out of that area that are also laying off. But those are other areas that are caused those issues. And we look at some of the industrials coming on strong, Caterpillar and a few others. So what we're seeing in that is that we said in all our newsletters and videos, it's really about employment and manufacturing index. Well, the manufacturing index came in at 49, so it's lower than 50. That's a contraction, right? So that's not a good sign. That means things are slowing down. We also had the CBOE, the puts to call ratios. It was up to 0.68, 0.7 to 1 is a bear market. We were down at 0.5, previous weeks. So we are reaching more back into bearish sentiment. That's really a part of the high-tech sector slowdown as far as earnings. But employment's still pretty strong, still pretty strong. And we're also having the infrastructure bill money. It looks like that's starting to show up because in the GDP came in at 2.6%, I believe, or 2.4%. Anyways, it was a huge increase from the minus the last 2 quarters. And there was a big expenditure in government, local, and city or state, excuse me, funding and expenditures. So I believe that's really indication that the infrastructure bill money is starting to hit. And we were saying all along, if the high tech sector and some of these major companies have to cut employees to overcome the cost of inflation, because there's going to be higher costs for borrowing monies. In addition to that, it's going to be a higher cost to retain employees, right? Because of the wage pressures out there with it, and mostly because inflation is people are pulling in, and they're going to be less on discretionary type of areas that they're going to spend money on. They're not going to go out to eat. They're not going to go to entertainment. They're not going to do a lot of things. They're going to pull in their horns. They're spending less all across the front because of the cost of electricity has gone up 60-70%. Oil's gone up in some cases 100%. And gasoline, we all know the story there. And the electricity really is just really starting to hit. The utility bills get re-rated twice a year. And I know a lot of places, November was re-rating as far as where they can charge customers based on state regulations more money. So that's all starting to hit. It's going to be really a painful wallet issue for a lot of the consumers out there and corporations, right? So good to see. The advanced decline is making advances. We're getting near that 50. If we can eclipse that 50-day and stay above it for some time, we've got some good positive areas out there. We also see the MACD is in, it's not over zero where we like to see that it's a positive influence on the market, indicating potential higher prices, but it is definitely have made a positive inflection. It's on an upward slope. What's important up here is also the relative strength index was down, well and oversold. Now we're getting into the midpoint 55, and that is really strong. That's telling us, stocks certainly aren't overbought. That's in the 65 to 70 range, but they are saying, hey, stocks are definitely showing they're getting buying. So all this is showing us buying pressure. So let's see, what else do we want to talk about? I want to go over, so the advanced declines definitely telling us that the market is looking healthier from a perspective of, people buying versus selling. So, we've certainly made our changes. We've got out of our short positions, except for the bonds. We've gone long the last couple of weeks. We've made some industrial type Dow Jones stock choices. We've seen some stellar gains there. We'll go over the trade tracker. We've gone long in all the indices because we've got buy signals that have generated. The Dow came first. Now I want to go over that real here. We use the diamond as our proxy. Diamonds, the proxy for our Dow. And if we could see here, this is the daily chart. A couple of things stand out. Of course, we've got our buy signal. We've been in there a couple of weeks now, and we've seen a nice response. We've eclipsed our a couple of key indicators, the 14 here in the gold. We've eclipsed that. The price that is quite some time ago. We eclipsed the 9 EMA, which is the black line. And then in addition to that, we eclipsed the 50-day. 50-day is a real good algorithm number out there. What do I mean by that? There's a lot of traders out there and fund managers that use that as a initial, hey, we should pay attention here because it can act as a point of resistance going forward, and it kicks off a lot of buy signals. So we're well above that in the diamonds. And then we got above the 200 EMA, right? Whoops, not that one, this one, right here, the blue line. We're eclipsed, we closed above that, and today we're still above that. That's a real good sign, because what does that mean? If there's downward pressure on the market, from a technical indicator and from a lot of technical traders out there and some algorithm quant trading out there, they're going to use the 200 as a point of inflection. If it acts as resistance, in other words, it brings it back, it abates selling because it says, hey, going below this, and it bounces off that, that's great news. Then below that, you get the 9 EMA. which is the black line. And then from that, we've got from the black line, then we've got the 14 EMA, and then we've got the 20, and then we've got the 50. So we've got plenty of areas of resistance on the Dow. Dow looks good. The stochastics, are really, that's our fast oscillator that crossed well above a while ago, early October. It's had this upward slope. It's way up in the 90s, very healthy. Yeah, it's flattening out, but there's no, if you look up here, the MACD, there's positive territory. The green oscillator for the mathematical formula is up at 5.18. It's well above zero. Upward slope, all good news, right? So the chance of will we get back to the bear market rally highs? Potentially. So the Dow's got some room to go. But I want to compare that to SPY, which is the S&P. We use the SPY ETF at S&P and a couple. And it was a busy chart, but this is the daily chart again. Well, let's start at the bottom. The oscillator, the fast oscillator. When we start seeing that green cross above the red and an upward slope and it gets up around 75, we pay attention. Well, it's up here and now in the 95s. So we certainly got our buy signal. We look at the MACD, that confirmed it's up in positive territory. That confirmed that, yep, we've got a buy signal. And then, of course, the 14 and the 9, and then also, too, the price now is above the 50. It hasn't got up to the 200, whereas the Dow did. So let me just point this out. We got the first buy signal on the Dow a couple of weeks ago. The following week, then we got buy signals on the SPY, the small caps, and the NASDAQ. And the NASDAQ we were really concerned about because, we knew tech earnings were coming out. We expected them not to be very positive. We weren't sure how market's going to respond, but we still had a buy signal, so we went long with a very quick finger on the trigger. Turns out that somehow the market shrugged that off, and we did have some downturns when the big companies reported, but then it raced back at the end of last week. So I want to point out here, if we're going just technically trading, not fundamentally, technically, and again, we use both fundamentals and technical. We meld the two on the Twomey investment process. We go into in detail in our market report. So go to the TwomeyStocks.com. That's the number 2MEstocks.com. You can get all that information. Read the letter. It goes over, in chapter and verse. It's 20 some odd pages every week that we go over. And it'll give you a deeper explanation than here in the videos. But the 200 EMA is quite, what are we at now? We're somewhere, we closed, this is midday, 386. The 200 EMA is up at, 403. So we've got some room to go. And what I'm trying to say here is the Dow led the charge. The Dow looks very much more impressive than the S&P. And, will the SPY, the small caps, all in the NASDAQ follow the Dow? And if they do, we've got some room to roll. And that means that the Dow could go higher. That means that's the Dow right here, are the diamonds. The SPY, as the SPY reaches up to the 200, we've got quite a bit of breadth to overtake there in pricing. So we may have an elongated rally here. And right now we're calling it a bear market rally. And that while everybody catches up to the Dow, since that's leading. And I want to just look at the small caps now. Small caps is on the heels of the Dow. Look at that. It's almost gotten up to the 200 EMA. And, all our other numbers very similar. So it's the Dow, the small caps, the SPY, and lagger of that is the NASDAQ. And we'll go to the Qs for that. And you can tell that's way down here. It's not even eclipsed the 50. If we go back and we're nowhere near the 200. So that's got, that's under pressure. We know why it's under pressure. That could be a drag on the rest of the indices, and time will tell. But it's very encouraging that the small caps tend to be, will come out of the doldrums early because they look at that as the first to get beaten down. So there's some positive signs here from a technical perspective. Okay, so that gives us a little bit of idea what's going on there. Let's take a break and go to our trade tracker here. And, we're still short bonds. We'll go over that a little bit. Our bonds, the first third and second third, we got hit. And we used the 20-year Treasury, Barclays, as yields go up, the Barclays TBT goes up. Obviously, this is a 200%, so it's 2 times the TBF. But anyways, the first third got stopped out at 42.5% gain. That was we bought on August 3rd, August 12th. We added to that, and that gain, that first stop, the second third, we got we got stopped out on that, so we got a 35.9% between those two gains, first third and second third. And we still got an active 1/3, and it's hanging in there at a 43.35%, from our all-in buy signal. So we're looking at the developments there. We'll see if that's going to continue. We're along the all the indices. We're up 3% for the. This is real time now. We're 3:30 into the market on Monday. The large cap, which is mimics the Dow Jones. We use Schwab's ETFs. The broad market or S&P is 1.3. The tech sector, we use XLK, that's 0.6, and 3.1 for the small caps. So we said the Dow and the small caps are racing up. What else do we sold out of all our shorts for gains of 9, 10, 6% on the NASDAQ, 5, 7% on the Dow, 6 and -2 and +6 on the S&P short side, and then the small caps we got 7%, a kind of flat -0.8, and then an 8 and a 6, and some good gains there on the small caps short side. But we're out of all those now. We'll be taking those off our trade tracker for next week's data. We got into a airline. We're up 4.8% there. We got into a conglomerate energy, oil, and gas company. That's up 10.5. We got into real estate REITs. Very interesting. We're up 3.5, almost 4% there, and then we're up over on another energy play, XLE, which is an ETF. We're up almost 11% there, and we're up 15% on our pipeline infrastructure, which also has a dividend of 7.3 annual. We just got a quarterly dividend, and it's still up 15% on from our initial. We took profits along the way since in our July buy, and took a 7 and 11% off the table. So we're really playing with house money there on that one, because that 15% and that quarterly 2 or 3% we just received for this past quarter. That where else are you going to get 15, anywhere from 7 to 15 to 20% in short order on your money on a 3 or 4 month? It's not going to happen. So that's between that and the TBT, we've done very, very well. And again, that you get that trade tracker. You can request that off our website, and it's a very easy. You go to the Twomey, the number 2 MEstocks.com, and just put it in, request, and we'll send it off to you. All right, so that's it. We've talked about how the advance and decline. We talked about trade tracker, energy. What's next? Let's hold off on that. Bonds. Let's take a real quick look at TBT right now. TBT, just from a technical perspective, fundamentally, has anything changed? Interest rates, the Fed's going to go up another 0.75 in November, or at least that's what everybody's pretty much baked in the goods, if they will. December, the 0.5%, interesting. Not sure. It still looks like it's a go, but last week we had a couple of things. Meister, on the Fed board, said that we may be getting to the point where we've gone far enough, and that set markets off along with the GDP number up to the races upwards, right? Also, we're getting some chatter out there that they're going to come December with inflation and GDP coming back. We may be peaking inflation. We may be at the point where the Fed's going to hold off after December's rate increase and maybe be more data dependent versus saying, previously we said they were going to raise rates well into the first quarter. They want to get to 5%, 4.5%, 4.75%, 5%, maybe 5.5% on the interest rate. They feel that they'll need to be there to get inflation rate from the 8% where it is. I don't know what's going to show up at the end of the month, but down to like at least get that in half. You can go chapter and verse. It's in the market report and the what the experts are saying. I've gave you really 2 or 3 cases on what's being said. Some are saying it's not going to be halved until 2025. Others saying end of 2023. So if that's the case, and where interest rates are still going to remain above 4.5% well into next year, I don't see the Fed holding back on, maybe they're going to be smaller interest rates advances, 0.25 or, maybe every other meeting. I don't know. I'm not in the prediction business, but I don't feel inflation is going to go away overnight. I really don't. Inflation doesn't start overnight. You hear me say this 1,000 times, and it doesn't go away overnight. So with that said, TBT, the yields, right now we got our sell signals, but we're looking at should we add or hold until we get our sell signal. We did get our first and third stopped out. If we look at a smaller time frame than the daily, the 120, you get 4 120-minute segments during the market. We're starting to get some good news there. We haven't got a buy signal there yet. If we do, we'll alert subscribers with a buy to add to the TBT or TBF, whichever one you prefer to use. At this stage, maybe too early to start adding, so we need some more to develop, and that's gonna really tell us a lot, probably mid the end of this week. We also have to determine if we are going to hold or add to our indice long positions, and we want to determine if this bear market rally has more legs to go. All right, what else do we want to look at? Let's take a look at a couple of. We looked at the advanced decline. I want to look at bear market history. Typical bear market over the average since 1946 to 2020, the total average is 11 months, 11, 12 months, right? That's the median. The average is 11.4, median 11.7. We're not even halfway through that median number, right? We're about 4.5, 5 months into it at tops, right? It was, I believe, June, the S&P hit bear market territory. So, the NASDAQ hit that earlier. So I'm not saying it's going to be 11 months, but if we want to pick a number out of the historical charts, which we like to do, we'd say we got a little bit more longer ways to go before we can get out of the bear market. And we certainly aren't out of the bear markets, but the Dow is making a charge. All right, that's keep that in the back of mind. I'm going to term this as a bear market rally. I know we had 2 negative consecutive quarters for GDP. That technically is a recession. We had the inverting of the curve. That's technically a recession. We just got the negative PMI below 50, not negative, but I call it negative, below 50. That's another indicator. We haven't had the employment shoe drop, right? We haven't had massive unemployment, although the tech sector is kind of accelerating some of that. That is really the last shoe to drop. The government and everyone else saying, we're not in a recession because employment and things are going good. Call it what you will. We're pretty close to being a recession from all those technicals I just mentioned. But that said, if we are not in we are in a bear market because the S&P and everyone hit those 20% more. But if we're not in a quote unquote recession, then this bear market may last longer. So let's see. We want to look at also midterm. This is probably a tougher chart to read because I couldn't get a nice PDF on this. But overall, 6 months after an election, we typically have a very positive bump. Even 3 months, very positive bump. In 2022, no, it was -3 after 6 months. 2002, excuse me. And then a +3.5, +18 by the 6 and 12 months. 2014, after 3 months, -1 on the S&P, but then it went to 3 and then ended up 3 at the S&P 500. The reason why I say 2014, that was the second term of Barack Obama, and he really lost a lot of seats in Congress. So that, if that happens, I'm not saying it will. If that happens here, I have no idea. But if we do, there is a lot of seats, we may see a lesser midterm bounce. The only time we really didn't get a 6 month bounce in the last since '62, I really don't see one here. I mean, just the ones I cited that were low. Uh, so midterms, we should start feeling a bounce, seeing a bounce. Earnings will subside. At the end of the year, we may, if we run in and let's kind of recap. If we get the diamonds or the Dow to continue its rise above the 200, right here, the 200 EMA, and if the SPY catches up, right. In other words, we've got more room to grow as they all catch up to the Dow. We may see a nice bear market rally. We're not really sure how all this is going to play out. We're not in the prediction business. We're going to follow our fundamentals, technicals. So our fundamentals necessary improving. The only thing that's really improving are two things. The economy is still strong with employment. We don't have that massive unemployment. Number two, government spending for the infrastructure bill, the CHIPS bill, that's starting to hit, specifically infrastructure. The only problem is when you have low unemployment or high employment numbers, everybody working, and you start overstimulating with these trillions of dollars that the government's spending, that's very inflationary. That's going to keep inflation high. If inflation stays high, the pressure is going to be on all these companies to eventually pass on those costs, which they've successfully done. Airlines, grocery stores, gasoline, utilities. But at some point, no matter, wages, which they are not keeping up with inflation. So if we stay at these high numbers of inflation, the Fed's going to continue to raise rates. We're going to get backward pressure on the economy, on the companies, and then we're eventually going to hit those layoffs. Manufacturing is already slowing down, but I expect if the infrastructure bill is hitting, that may reverse itself, and that may be just a short-term trend. Don't have time to do this here. I'm going to do another segment on the energy. That's really a lot has developed over there. Between Europe and here locally. We're getting some shortages here as Europe is going into excess. They've got complete 6 to 8 weeks, 100% storage, if you will, and they've got LNG tankers sit in the ocean trying to get unloaded. We, on the other hand, the Northeast, and now the Southeast has got 20 days of diesel. So we've got, I want to do a separate segment on that, and that's going to also impact. So see where I'm coming from? We're seeing some great indicators technically telling us, hey, the market's going forward. Fundamentally, we're not out of the woods yet. A lot of this is predicated on folks thinking the Fed's not going to raise rates or they're going to abate raising rates come December, and then the midterms and things are going to go racing off. Fundamentally, companies have kind of weathered the storm other than high tech. I know I'm repeating myself, but that's causing us positive bias in the market. Our fundamentals and technical, the Twomey investment process, you can read that in our market letters. Please go into the website, take a look at that. That's number 2, mestocks.com. You can get all caught up and on the, some of these terminology that we're using here. And then, we'll start going into more charts this week and get some more of these videos out for our subscribers as well as, everyone else out there that can visit the website. I'm James Twomey. Today is October 31st, 2022, Monday, and we've got great developments in the market. We're taking advantage of that with some terrific gains that we've sold off and as we switch positions. And stay tuned for further notice of positions out there. We'll get to you as soon